Welcome to The Good, the Bad, and the Economy. And I'm your host, Napoleon Olarte. Today we're going to talk about economic indicators, at least some basic ones. The gross domestic product, inflation rate, and unemployment rate. Why we pay attention to them, what it means for us, the regular consumer, and why it is useful if you're trying to start a small business or if you already are a small business owner. I just want to remind you that the information provided in this podcast is for entertainment purposes and is not financial advice. Always do your own research before making any personal and financial decision. Consult your attorney or a financial professional like a CPA. I want to start today with a story. So, back in the early 2000s, I was working as an escrow officer for a huge Century 21 office, the biggest one in town in terms of the number of agents. We had close to 600 agents there. Over time, real estate prices started to increase from the low 200,000s to the mid 300s, and as a consequence, also did sales commissions. Every time I closed a transaction, I saw the agent's commissions checks, which were, in many cases, 2 or 3 times my monthly salary. I decided to study for my real estate license and became an agent because of that. One day, soon after that, early in the morning, I gave my boss my 2-week notice. That same day, at lunchtime, he called me up to his office, sat me down, and pretty much told me that he denied my request. He did so by adding that it would be a huge mistake given that the upcoming real estate bubble was going to burst, and besides, he raised my salary by 25%. Interestingly enough, it was that this is 2003, almost 5 years earlier than the bubble actually burst, and he was already talking about a bubble. Anyways, 2 weeks passed from that meeting and I submitted another 2 weeks notice. My boss tried to convince me not to leave again, but I was mentally prepared this time to put my foot down and told him that I was sure of my decision. So I left and went on my own. Primarily, I was working as a loan officer and also was selling real estate here and there, as many agents did back then. As the decade progressed, so did the real estate market, forming one of the greatest real estate bubbles in history that came to end together with the Great Recession of 2008. And the Great Recession killed 80% of all home loans and real estate businesses, including mine. But as a result of that, I learned great lessons. And lesson number 1 was, I have to pay attention to the economy. My old boss certainly did. And the next logical question is, how do I do that? And that's what we're going to talk about today. The economy goes through cycles, but the most obvious one is the yearly cycle. Economists like to track data in order to compare it from one year to another, or to find a trend or a pattern, and from that make projections. We're going to call this data economic indicators. Some indicators are what we call lagging indicators because the data that we gather is from the past. For example, let's say the labor market indicator would be the unemployment rate. This past week, we had the unemployment rate for last month. Looking at it, we can tell what level of unemployment we had. However, it won't tell us what level is going to be the next few months. We can look at a few months back and we can figure out a trend and observe whether unemployment would be increasing or decreasing and how slow or fast those changes took place over time. The Federal Reserve would look at this data also to figure out if the economic policy they took in the past has already reached the labor market and brought in the results they expected with such policy. The same thing happens with inflation, which is another economic indicator that tells us how much prices are increasing or decreasing, mostly as a result of consumer demand. Another economic cycle is the expansion and contraction cycles. This is a measure of the well-being of the economy, and the main data set we take into consideration is the GDP or gross domestic product. In a previous episode, we defined what GDP was and how we get that number from the economy. Let's just simply say that it is by definition the value of all goods and services produced in an economy in a time period. For GDP readings, we tend to use quarterly and yearly cycles. A positive GDP means the economy is growing. We call this expansion, and 2 or more quarterly cycles with negative GDP will define an economic contraction or a recession. When recessions are wide and deep, we call it depressions, like the one from 1929 to 1939 that we call the Great Depression. So, coming back to economic indicators, I want to point out that there is not one more important than the other. But when we look at economic data, we have to look at the big picture. And sometimes looking at the bigger picture might not give us a quick snapshot of the state of the economy. But looking at just a few indicators could do just that. The main ones I look at, because the Federal Reserve always makes reference to, are GDP, the inflation rate, and the unemployment rate. If I want to go a little more in depth, I will also look at the state of the real estate market, home sales, inventories, days on the market, and so forth. And I will also look at consumer confidence, retail sales, energy, and oil prices, along with import and export data. But for our purpose today, to simplify things a little, let's concentrate on these three: GDP, inflation rate, and unemployment rate. Why? One of the most used tools the Federal Reserve has to influence the economy is the Fed funds rate. When the Fed decreases rate, they're trying to stimulate the economy. And obviously, when they increase rates, they do the opposite. The motivation to do that is their mandate and commitment to maintain price stability in the economy. They believe that price stability is when the economy reaches and maintains the CPI, or Consumer Price Index, which is a measure of inflation, at 2%. They assume that inflation over 2% means that consumer demand is high and could bring bigger problems in the long run, but also believe that inflation under 2% means we have too slow of economic growth and that could halt the economy into a recession. The same thing occurs with the unemployment rate. Many economists believe that a healthy unemployment rate is around 3 to 5%, and the reason it is not zero, which we intuitively would think is the optimal target, since it would mean everyone who can work is working and being productive, is that in microeconomic theory, we believe that when real wages exceed the marginal product of labor, it is costlier to the company, and the company would choose not to produce at a loss. In simple terms, this means that economic theory suggests that there is a point under that healthy margin of 3 to 5% of unemployment that, if we go under, could be costlier to producers in the economy. On the other hand, unemployment over 5% means that the labor market is weakening, and that could cause lower consumer demand because people are being cautious in their spending because of fear of losing their job as a result of a weak economy. Now we can see the correlation between the Fed funds rate in the economy and why they pay attention to and monitor these indicators. Increasing or decreasing the rate would make things more or less expensive, respectively, for companies and consumers, which, leaving everything else equals, translate into companies firing or hiring employees, which both of these outcomes would increase or decrease consumer demand and as a result influence GDP. The problems with these indicators for the Fed and for all of us is that they are lagging indicators. They paint a picture that has already happened. For example, when the Fed increases or decreases its rates, we will see it reflected in the unemployment rate no earlier than 6 months and in the inflation rate no earlier than 6 months to a year. The same occurs for GDP. Now, business owners and consumers have to pay attention to the state of the economy through economic indicators, because they would determine what the Federal Reserve is and will do in terms of economic policy. Some would argue that inflation, GDP, and unemployment data are rigged in favor of politics, but that's irrelevant, because the Fed would use those numbers to justify its actions at the end. And as a business owner, I want to know what the Fed is most likely going to do. If I have the need to buy new equipment in the foreseeable future and rates are low, and I know the Fed is going to increase rates, the logical thing to do is I should find a way to purchase if I need to finance the equipment right away, or hold off for some time if I expect rates to come down. If I'm a real estate broker and rates are going up rapidly, like they've been in the past few weeks, I should expect that mortgage rate should go up and thus pricing a number of buyers out of the market. So I should not contemplate the idea of expanding my operations and maybe think about cutting some costs instead. As a regular consumer, it is the same thought process. Whether I want to buy a house or finance a car, get into credit card debt, or maybe do one of those 0% for a year credit card transfer deals some companies have. The bottom line is that being informed and paying attention to the economy in terms of indicators and the Federal Reserve actions could help you make better personal and business decisions. I want to emphasize the purpose of this podcast. I believe everyone should have at least basic understanding of economics. It might be intimidating with all the numbers, formulas, and theories, but you don't need all that just to get a feeling of where the economy is going and how that direction is going to affect you as a consumer or as a business owner. And all I want to do is just to point you out into the right direction so you can find economic information and be able to understand it so you can make sound decisions. Thank you for your attention, and for now, this is it. If you like the content, like the video on our YouTube channel and subscribe. Until the next episode, goodbye.